BMO Capital Markets suggests that S&P can remain resilient even if megacaps face challenges. According to a BMO U.S. strategy comment report, the stock market, S&P 500, has remained resilient during previous periods when megacap stock outperformance began to wane. Led by Chief Investment Strategist Brian G. Belski, analysts observed that an analysis of the 10 largest S&P 500 stocks in comparison to the rest of the S&P stocks indicates that the relative performance just completed one of the best years ever for this subset. These trends, analysts remarked, are highly unlikely to continue this year, potentially resulting in a stronger performance for the rest of the S&P on a relative basis. Since 1990, the S&P 500 has recorded an average return of 14.3% in the years following relative performance peaks, excluding the tech bubble in 2001. Analysts believe a bull market for U.S. stocks started after the S&P 500 bottomed in October 2022, and historically, the S&P almost always had technical corrections at some point during the second year of a bull market. So even if these stocks begin to struggle, causing broader market weakness, we do not believe that this alone negates our bull market outlook, analysts said, suggesting that investors should continue to be active in the market rather than passive or reactive to shorter-term performance trends. In addition, style and size indexes have seen similar gains since October 2023, compared to the prior large cap and growth trends that dominated 2023. Also, the S&P 500 equal weight, mid-cap, and small-cap indexes all saw losses in 2023 through the October 2023 S&P 500 price low, while the S&P 500 Growth Index significantly outperformed the Value Index, 12.4% to 1.2%, respectively. Since then, these indexes have gained about 17%, compared to 20% for the S&P 500, showing that although growth is still leading performance, the gap has substantially closed. BMO analysts also show that market internals for the S&P 500 have also improved significantly. From October 2022 to October 2023, 139 S&P stocks outperformed, but from October 2023 until today, about 231 stocks are outperforming, roughly 46% of the index. In addition, the contribution of the top 10 S&P 500 stocks, which were responsible for 120% of the index return last year, through October 2023, has dropped by about 33%, in line with the historical average. Lastly, valuations for the top 10 stocks are believed to be stretched relative to history. These stocks' next 12-month PE is about 27.9x today, which is more than a 45% premium to their long-term average. The rest of the stocks in the index have a next 12-month PE of 17.8x, representing a slight premium to their longer-term average. The next 12-month EPS growth for the rest of the index, on the other hand, bottomed out earlier in 2023 and has been improving since then. Thus, we believe reasonable valuation and a recovering earnings backdrop strongly favor these stocks and would recommend that investors position portfolios accordingly.